I'm joined by Sarah Hewin. She's senior economist with Standard Chartered. So, Sarah, thanks very much for coming in. Let me first ask you for your reaction to the Fed's action.
Well, it's broadly as we expected. The Fed downgraded their outlook for growth. They gave slightly more downbeat view of the current state of the economy, and they decided to, they announced that they would reinvest some of the profits from their current mortgage bond holdings.
Now, we were having an argument this morning about whether this is QE2 or not, because essentially the balance sheet is the same size.
Yes, we wouldn't really regard it as new quantitative easing. We feel that it's the Fed sending a signal that it doesn't want to water down any of the QE that it's already done.
And do you think it signals that they're willing, or perhaps think they might need to actually expand the balance sheet next time around?
Yes, I mean, I think the Fed has acted in a very pragmatic way. They're going to continue to watch how the economy develops. In our view, growth is likely to slow further in the US. We think that we'll be close to zero inflation by the end of the year, and this, in our view, makes it much more likely that new quantitative easing will be undertaken by the first quarter of next year. We certainly don't see US interest rates rising anytime soon, not until well into 2012.
So the recovery is losing steam in the US. It's also losing steam here in the UK. We just had consumer confidence fall overnight. What do you make of the data that we've had out of the UK?
Well, the last few weeks have certainly indicated that some of the strength that we saw in the second quarter is starting to fade. Various survey reports, as you mentioned, the consumer confidence reading, the retail sales number, house prices, service sector, the purchasing managers index, construction, all of these have really peaked out and suggest that the pace of growth is going to slow in the second half of this year.
Now, with regards to the housing market, I'm interested in how important this is. We know a lot of people own homes in this country. How important this is to the economy. We just saw prices drop for the first month in 12. Is that going to continue, do you think, that trend? Is that going to become a trend?
I think it probably could. I mean, certainly there are a lot of factors that suggest it's going to be tougher in the housing market than it has been over the last 12 months. The unemployment rate is high. We're likely to see more job losses in the public sector, of course. Earnings growth is very weak. It's quite difficult for householders to raise finance, to borrow, to even find a deposit to put down on a new property. So all of these factors together mean that there are quite substantial headwinds in the UK housing market.
Now, how will the Bank of England be taking that news about the housing market and the other and the confidence data as well? What are they going to be thinking about?
Well, I think that they are likely today to downgrade their growth forecasts. They had some very strong forecasts for 2011, 2012 in the anticipation that we would see a normal bounce back after a recession, which has certainly happened in the past. This time round, though, there are additional problems. Obviously, the financial crisis caused the slowdown, and I think that they're likely to be much more downbeat on the outlook.
Quickly, Sarah, we've also got the inflation report today. Do they have room to do more in the UK in terms of quantitative easing, or is inflation too much of an issue?
They certainly have room to do more. They see the current high inflation rate as down to temporary factors. Those temporary factors will linger on through to next year. Nevertheless, if they feel the need to do more quantitative easing, I don't think they'll have any hesitation in doing that.
Okay. Sarah Hewin, senior economist at Standard Chartered, thanks so much for coming in.